All right, I think we will get started. Good evening, everyone. Welcome to today's webinar, Should I Contribute to My RRSP? I'm Jonathan Tucker. For those of you who don't know me, I'm the Managing Director of Tucker Professional Corporation. And thank you for making time this evening in your schedule to talk about the importance of RRSPs. Why is this such an important topic? Well, because the decisions that you make today will affect your life in the future. And so often I find that clients will contribute to their RRSPs because they're interested in reducing their tax now, but they're not aware of what happens in the future. And so the decisions you're making today should be informed ones because it will affect your financial life in the future. RRSPs are a useful tool, there is no doubt about that. They are useful in deferring tax or postponing tax, splitting income, and protecting assets. So, but we want to learn to think strategically about using RRSPs rather than just blindly contributing to them. I want to start with a real-life client story, and it kind of sets the stage for our session this evening. The story is of a client. I haven't worked with this individual for all that long, but last year they turned 71 years old. And with RRSPs, once you've contributed to an RRSP throughout the course of your career, once you reach age 71, you are required to mature the RRSP. That is, you roll it into an RRIF, a Registered Retirement Income Fund. And from age 72 onwards, you have to start to take the money that you've put into your RRSP out. And when you take it out, it gets taxed. It becomes part of your income. And so this person followed the advice that was given to them by their accountant. They're a physician. They had a professional corporation. And each year, the advice that was given by the accountant was, make sure you have enough income, enough salary in order to maximize your RRSP contribution. And so they followed that advice religiously. And now that she hit age, or he hit age 71, the RRSP had to be matured. They had done well, they had invested faithfully, and they had had good returns on their RRSP. And so the value of the RRSP was about $3 million. So that's the first part of the story. The second is this person's spouse had also followed the same advice and had also contributed to their RRSP. A couple of years ago, this person's spouse passed away. And when a spouse passes away, the RRSP rolls to the surviving spouse. And so this particular client now found themselves with two RRSPs, both worth about $3 million each. So don't feel too sorry for them, for this individual. He's got $6 million. The problem is a tax problem, because now he will have to take out a certain percentage of that RIF each year. You'll have to take out this year a little over 5%. There's $6 million. So a little over 5% is about $310,000. That means that every year from here on forward, he's going to be paying tax in the top tax bracket in Ontario, because in Ontario, once you earn more than $220,000, you pay tax at 53.53%. And so there is absolutely nothing I can do at this point to save this person tax. They have nothing but to unwind the RIF, which was their RRSPs, and take it into income for the rest of their life. And so that's where the topic of the question of should I invest in my RRSP comes to us this evening, because unless you've got a plan for contributing to your RRSP, you could very well, as a high income earner, find yourself in the same boat as this other client did. So when I talk about learning to think strategically about RRSPs, what we want to do, if we know that the outcome of that particular individual who was a physician, had a professional corporation, was one where they had no choices, then maybe we want to pause and think about what could have been done to leave them more options than they presently have. For those who are healthcare professionals that are operating through a professional corporation, you have options, and we'll get into that this evening. What are those options? If I've got an MPC or a dentistry professional corporation or a veterinary professional corporation, what have you, you're operating through a PC, do I even need to consider an RRSP, or is my professional corporation an RRSP of sorts? So that sets the stage for what we're going to discuss this evening. Now, on our agenda, should I contribute to an RRSP is the first question. How much can I contribute each year, and how is it calculated? What is a spousal RRSP, and why are spousal RRSPs important? Is there a difference between what I can contribute and what I can deduct? And that question, I hope I can explain clearly to you, because people oftentimes get confused with that. The difference between a contribution and a deduction. And then we'll look a little bit at tax-free savings accounts versus an RRSP, which is better. Are RRSPs always for retirement, or can they be used at other times during my career? And what about if I put too much into my RRSP? What are the consequences? And then we'll have some time for questions. So that's our agenda for the next few minutes. Let's start out with the basics. What is an RRSP? Well, an RRSP is a registered retirement savings plan. The term registered is used with several different accounts: a registered retirement savings plan, a registered educational savings plan, a registered RDSP, registered disability savings plan. All of those types of plans are plans or accounts that are registered with the government, and special tax rules apply to them. So any of these registered accounts are tax deferral vehicles, or tax savings vehicles. The income from investments in the plan are not taxed as long as they remain inside the RRSP. And there's not much in the way of opportunity for withdrawals. There's really only two if you're trying to avoid paying tax. One is a lifelong learning plan, which is a loan. You borrow $20,000 out of your RRSP for education. Or the more common one is a home buyer plan, which is also a loan where you take out $35,000, you borrow $35,000 from your RRSP, and that's not added to your income. If you take money out of your RRSP for anything else, it's taxed as a withdrawal. So that needs to be considered. And one other on the slide there, if you put too much money into your RRSP, if you over contribute, you're permitted to take that money out, and that won't be added to your income. All right. Now, what can I invest in with my RRSPs? Is there any restrictions on what can be used? Well, what you see on the slide here is not a complete list, but you can contribute cash, bonds, ETFs, GICs, mortgages. Mortgages is an interesting one. Securities that are listed on a designated stock exchange in Canada or other countries, and some shares in private corporations, investment grade gold and silver bullion, coins, bars, and certificates on such investments. When I mentioned about mortgages, it is quite possible that you could loan the money out in the form of second mortgages or those types of vehicles on real estate, but you can't own, for example, real estate. So when we talk about qualified investments, we want to make sure that what you put into an RRSP meets the definition of a qualified investment. And if it doesn't, then there are severe penalties for contributing or for investing in non-qualified investments. A penalty like 1% per month of the amount held in an RRSP account. So that's 12% a year on what's contributed. And then if you earn any income on that, then that income is subject to tax, and it's subject to tax at the top rates. So the government is discouraging people from investing in things they ought not to invest in their RRSPs. If you put too much money into your RRSP, if you over contribute, then there's a penalty for that. How do you know how much you can contribute? Well, if you look on your notice of assessment, that's the form that the government sends out to you once you've filed your tax return each year. It's like a receipt, but it's several pages long. You'll see a box there, and the box will talk about your contribution limit. And so that will tell you how much you can contribute to your RRSP. And then the other thing to be aware of is if you put too much money into your RRSP, these penalties for overcontribution are serious in and of themselves, but there's also a separate return called a T1 OVP return, which must be filed on time. And if it isn't filed on time, then there's a penalty for that. So you make sure that you don't put more than you want to or are permitted to inside of your RRSP. All right, what should I consider? If I don't have an RRSP, what should I consider before opening one? Well, firstly, am I even eligible to hold an RRSP? In other words, do I have the type of income that will enable me to contribute? So if you earn only investment income will not qualify as earned income. So it needs to be a certain type of income like salary or self-employed income. You must have a social insurance number. You must have filed a tax return previously, and you must have the available RRSP contribution room to do that, or you will immediately over-contribute and find yourself in a penalty situation. Other considerations before contributing to an RRSP. Am I a US citizen? Because if I am, the income that's generated inside of an RRSP for US tax purposes is treated like just any other investment account for US tax purposes. Whereas here, we have special tax rules that shelter that income. Does my age permit me to contribute to an RRSP? If you're older than 71, you're out of luck with respect to contributing, generally speaking. The types of investments to be considered to an RRSP. So remember, we talked about qualified investments. The investment risk, this is something sometimes people forget. If I invest, if I invest in a high risk stock outside of my RRSP, I pay $1 for it and it goes to a penny. That loss is a capital loss. That loss I can carry forward into the future and claim that or offset any future gains with that loss. Whereas if there's any loss inside of my registered account, if I buy a high risk stock inside of my RRSP and it loses money, I can't claim the loss against future income. So one wants to be careful when you're investing inside of any registered account, whether it's a TFSA, an RESP, RRSP, RDSP, any of those accounts. Remember, keep the investment safe, because if you lose money in there, there's no recovery as a loss in the same way as if it were outside of an RRSP. The types and sources of income, dividends, rental income, you must have the right type of income. We talked about that previously. And then the other consideration is, do I need cash in the future? In other words, if I'm going to put money into my RRSP, and I need money in the future, maybe to repay debt or maybe to buy a house or do something like that, I'm taking money off the table, because once I put it into that RRSP, I'm going to pay tax on it if I withdraw it. So what's my future need for cash? And does it make sense for me to contribute now to my RRSP? So you want to consider that as well. We'll go into that in more detail as we continue. How much can be contributed to an RRSP each year? Well, there's a RRSP contribution limit, and for 2022, it's 18% of earned income reported on your tax return for the previous year, up to a maximum of $29,210. So if you had earned income last year of $200,000, that earned income exceeds $162,000, so the amount that can be contributed based on that is $29,210. For 2023, for next year, the dollar limit increases to $30,780, which means this year, if you want to maximize your RRSP, then you'll want to make sure, if you have a professional corporation, that the salary you set for yourself is $171,000 this year, in order to next year be able to contribute the maximum amount of $30,780. The contribution room always works on the prior year's earned income. So that's why we're saying, let's look into 2023 and make sure we have enough income for 2022. Now, a couple of cautionary notes. If you participate in HOOP or other plans like that, those contributions, those plans will also impact the amount you can contribute to your RRSP. So you got to take that into consideration. And your RRSP contribution limit may be reduced or eliminated if you don't have earned income. All right, so those are some of the considerations to be taken into account. Now, I told you when we started out about this story about the person who had too much money in their RRSPs that they lost control over their taxable income in retirement years. And I don't want you, as we go through this session, to be thinking that I am against RRSPs. I'm not at all. RRSPs play an important part. I have an RRSP. I have a professional corporation and I have an RRSP. The question is, what's the most strategic use of both of those vehicles? And so I don't want you to feel like I'm trying to lead you or lead this session into a situation where I say your professional corporation is the only viable retirement vehicle to use. That's not where I'm going here. I just want you to be aware of the pros and cons of each. All right. One of the questions, and this is a bit of a side question, is how much do I actually need to retire? And I find myself having this conversation with a lot of people because this is oftentimes an unanswered question. And people will find themselves making purchasing decisions around buying a house, an expensive house, or paying down debt or things like that. And they won't decide on the most important part of that wasn't supposed to happen. Excuse that. They won't decide on the most important decision before they make those major purchasing decisions, like a house, which is the question of how much do I actually need to retire? And so I wanted to raise that with you this evening. So, sorry, Don, I just leave. Thank you. Are we good? Mustafa? Yeah, we're good. Okay. I wanted to raise this question with you because it's an important question for you to consider, and is not a hard. It's not a hard question to answer. But I have a little template, a little back of the envelope calculation that I would encourage each of you to go through. I say to people when we talk about this topic, I say, give me 5 minutes of your time and I'll show you how simple this is to get started. But in this particular case, you can see where we go at the bottom of this screen is to identify how much this particular individual needs to save every month between now and when they retire to make sure that they have enough money to retire on and to continue to maintain the lifestyle in which they've become accustomed. In this particular instance, the person needs $1.3 million. That's their saving target over their lifetime. We were able to calculate that in about 5 minutes. And if any of you are interested in going and taking 5 minutes of your time to walk through this calculation, I guarantee you will never forget how easy this is. But it's probably one of the most critical things to take into consideration as you go throughout your career. In this particular case, the individual was 32 years old. They were considering whether they would retire at 65 or 70, which meant that they had 33 years or 38 years remaining to save. Over that span, they just had to put aside $1,047 every month, or $745, depending on how many years they would work. And they just had to monitor their earnings each year on their savings to make sure that they were getting at least 6% per year. And if they simply did that, if they simply saved $12,564 or $8,940, they would have $1.3 million set aside in order for them to continue to have a stream of income based on their living expenses, commensurate with what their current living expenses are. This is such an easy, but such an important exercise to go through. So I put that in here because this has to do with the topic of retirement. It is a little bit broader than specifically RRSP, but I would be remiss if I didn't encourage each of you, if you haven't done this, to sit down and go through this exercise. I'm happy to do it with you if you'd like, just to figure out, am I on target? Before I go out and buy that new house, can I afford that house while at the same time saving for retirement? All right, enough said about that. We're going to do a couple of case studies now. Dr. Nisha, she's 28 years old. She's presently a PGY1 in family medicine, earning $65,000. Her goals, her financial goals, is to pay off her $80,000 line of credit and to purchase a home and start a family in the next couple of years. She has nothing at present in her RRSP, and so she's pondering the question as to whether or not she should contribute to her RRSP. Her colleagues say she absolutely must do. So let's consider whether Dr. Nisha should in fact do that. So what happens if she doesn't contribute to her RRSP? I told you she was earning $65,000 a year in the previous couple of slides. We know that she's permitted on that salary to contribute 18% of the, where are we here? 18% of that salary of $65,000, which means that she can contribute $11,700 of her income from last year to an RRSP. She doesn't make a contribution this year. So what happens? She's allowed to put 11,700, but she doesn't do anything. Well, she has what's known as a remaining RRSP contribution room. All right, and that room of 11,700 carries forward to the next year. In the following year, she earns $67,000. She can again carve out 18% of that, which is $12,060, and she has to decide, am I going to contribute to my RRSP in the following year? If she doesn't, her contribution room grows to $23,760. That's $11,700 in 2018, 2019, $12,060. Ignore the years here. Nothing's changed in terms of the rules for contribution limits or room in years. The point of this slide is to show you that if you don't contribute each year, you don't lose anything. It just gets carried forward. So now after the second year, she can contribute $23,760. The unused contribution room gets carried forward. Okay. What happens to her RRSP contribution room if she contributes $2,500? Same fact pattern, same years involved. You can see here that she started out with 11,700, if you recall. She contributes $2,500. That's all she can afford. She's a medical resident and she's got a line of credit. So what happens to her contribution room? It's reduced by the $2,500. So she now has $9,200 of unused contribution room. The next year, she earns another $67,000. So that builds her contribution room by $12,760. At the end of 2019, if she makes no contribution in 19, her contribution room is $21,260. The contribution she's made is not the full amount of what she could have in either year. It just reduces her contribution room. All right. So the other question that we have to consider here is, what about the available RRSP deduction? Remember I said to you at our outline when we looked at our agenda, talking about the difference between a contribution and a deduction. All right, I'm just going to make a slight change here on my screen. All right. So if you recall, we were talking about the contribution and what her contribution room was if she made a small contribution, but we didn't talk about the deduction. What do you mean about the deduction, John? What are you talking about there? Well, an RRSP contribution permits you to make a discretionary deduction. That means that if you contribute to an RRSP, you have a deduction permitted of the contribution you've made. She contributed $2,500, but here's the question. Does she want to claim the contribution? Does she want to reduce her income by the contribution? Because if she does, she's going to use her RRSP and deduct that contribution against her income. So you can see the way the slide is set out here in terms of these two sections. One is to keep track of the contribution room that she's permitted to make. The other is, all right, how much of the deduction has she actually claimed? Remember in 2018, she only contributed $2,500 because she was only making $65,000 at the time. Because she's in family medicine and she'll be done in 2 years, then her income is going to go up significantly in 2 years' time. She'll probably be in top tax bracket in 2 years' time. Whereas right now at $65,000 or $67,000, the amount of tax she's paying on that is quite small. As a percentage, it's a much lower percentage than what she'll be paying in, say, 2020. So in this case, it would make sense for her to carry the contribution forward and recognize that she has a $2,500 deduction that she can utilize. The only planning I'm suggesting that she consider here is that she carry the contribution forward and use that contribution against her income when it's higher, when her tax rate is higher. All right, now, I think I'll skip past this slide to take you to this slide. So we add a few years here just to demonstrate the point I was making. Remember, she was making 65,000 in 2018, 67 in 2019, and then 225,000 in 2020. In Ontario, if you make more than 220,000, it's actually 221,000 this year, the amount of income you earn over and above that amount of 221,000 is taxed at top rate. And so in this case, we want to consider, all right, maybe we want to start to deduct that amount of money or deduct the previous contribution against this year's income to get her income from 225,000 at least down to 221 to get herself out of the top tax bracket. And that's the purpose of this slide. It's to show that her contribution room continues to grow as her income grows. And you can see that as we, just let me switch over here. You can see that as she continues to earn income, her contribution room increases. And then she continues to make contributions into her plan, and you can see what happens to her contribution room. She contributed $2,500 in the first year, you remember? And then as her income goes up and she has more money in 2020, she contributes $15,000 to it, which reduces her contribution room. So now she only has left $33,490. And you can see how this continues to carry on each year as her income is in excess of these levels of income. All right, I don't want to go into too much detail here, other than to say that there is a tax minimization, there's a tax reduction strategy here to be considered. When you contribute to your RRSP, ask yourself, do I want to claim this amount against my income this year? Or do I expect my income to go up significantly over what it is at present, assuming that you're making less than 221,000? So I'm talking to the medical residents on today's webinar whose income is under that amount. If that's the case and you're contributing to your RRSP, consider carrying that contribution forward and not deducting it against this year's income. Consider deducting it against future income. All right. Now, how are RRSP related withdrawals taxed? Let's supposing somebody decides mid-career, and this, we'll see a slide in a few moments, which will talk about our RRSPs only to be withdrawn in retirement. Is there a time when it would make sense to withdraw money from an RRSP during the course of your career? And there can be. Maternity leave would be an example where your income's low. That could be a time where you might want to use the savings that are set aside in this registered account. That's why I drew your attention to the fact that this is called a registered retirement savings plan. It's a registered account, but it's a bit of a misnomer because there may be times when it's expedient to use the money inside of there for certain purposes when your income is low. When you do take that money out and you take it out for purposes other than home buyer plan, lifelong learning plan, or you've contributed it too much and you need to get back on side. When you take money out just because you need money, it gets taxed at the highest possible rate. And what do I mean by that? I mean this. On this screen here, we talk about the the tax brackets and the level of tax expressed as a percentage of different types of income. If you're a medical resident, if you are a self-employed physician, in other words, you're not incorporated, then the income you earn from the practice of medicine, the income you earn as a medical resident, is considered to be what's known as other income. In other words, sorry, I'm using the wrong term, ordinary income. It's income that's taxed in this column, all right? Now, take a look at the 4 columns. We have ordinary income, that's the rates of tax that are applied against employment income, self-employed income, interest, rental income. All of those types of income are taxed in this column. And if you earn more than $220,000 in 2021, anything over that would be taxed at 53.53%. So when I said about Dr. Nisha, when her income was, in this range down here, then the tax savings for that contribution of $2,500 would have been 29.65%. If she waits until she gets into practice and her income exceeds 220, see, the same contribution is worth 53.53%. Okay, when you take money out of your RRSP, it's taxed in this column. This chart will become important to us as we continue to consider whether we use RRSPs in the future or not. I just want to draw your attention to the fact that we are taxed on different types of income at different types of rates. So as you look at this, go to the highest amount down here. This is the highest level of income where the rates of tax are the highest. And ask yourself this: if I were in that tax bracket and if I were to earn $1, which column would I like the dollar of income to be categorized as? Ordinary income in this column, dividend income in these 2 columns, so you can see the rates of tax here, or would I like to earn $1 as a capital gain where the tax rate's here? So I want you to keep that in mind as you consider the type of income you earn in the future: investment income, salary, self-employed income. If you operate through a professional corporation, then the question comes, do I take my money out as a salary or do I take it out as dividend? Look at the difference in tax rates. All right, that was the purpose of that slide, was to show you our different types of income are taxed at different levels, and also to show you the effect of the tax rate as your income increases. All right, so should she claim the RRSP contribution made on as a deduction against her 2018? I think we've concluded that no, she should defer it and carry it forward to 2021. And to quantify the tax savings of her doing that, she would actually be saving $1,338 on her contribution. So the tax savings on the $2,500 would be $1,338, and she would save $594 by deferring that contribution and deducting it in 2020. And in 2020, her overall tax savings would be $1,338.53. Okay. So now let's step back and take into consideration Dr. Nisha's original goals. Remember, she has no RRSP, she has no debt, she wanted to buy a house, she's thinking about starting a family in the next couple of years. What's the overall recommendation for her? Well, it's put $35,000 into her RRSP, so contribute $35,000. I would say don't put any more into it than that at present. At the time when she wants to buy a house, she can then withdraw that $3,500 or $35,000 from her RRSP. So she's not put money away that she doesn't have access to, and she has the benefit of a deduction of $35,000. So that $35,000 is withdrawn under the home buyer plan. She gets a deduction against her income, and she now has cash of $35,000, which she can put with the rest of her cash as part of her down payment for the home. All right, I think I'm going to skip through this scenario because we've covered that off, and I want to move on to case study number 2. And this is Dr. Mark. Mark is a radiologist. He's 36 years old. His income is $735,000. He earns that through a professional corporation, and that professional corporation is earning passive income, which we haven't talked about yet. So this is a bit outside of what you might be expecting in terms of RRSPs, but you'll see in a second how this comes into play. And his monthly living expenses are $11,250 or $135,000 a year. As I say, he's operating through a PC, and his goals are to minimize tax and to pay down his mortgage. He's got $35,000 in his RRSP as a loan right now. He's taken the money out, but he owes his RRSP $35,000 because it's a home buyer plan withdrawal, which is a loan. And he's got a massive RRSP contribution room that he hasn't used, $235,000. He was at the bank the other day, and one of the tellers said to him, "You should actually transfer your stock from he had bought Tesla, and you should transfer that into your RRSP." Was that good advice or not? We'll see in a minute. Should Dr. Mark contribute to his RRSP, and if so, how much? So on this slide, we have two scenarios. One is an employee or a self-employed professional, someone who has not incorporated, and they have three options for reducing their tax. One is contribute to an RRSP. The next is put money inside of their tax-free savings account. Another bucket or another option could be purchase a permanent life insurance policy, because there's an inside account where you can put money inside that account, invest it, and it can grow in a similar fashion to an RRSP untaxed. That's the person who is not incorporated. They're an employee, they're self-employed, and they're operating their practice as a sole proprietor. On the other side of the slide, we have the incorporated professional. What options do they have? Well, they have similar. They have an RRSP. They also have a TFSA. They could invest in a permanent life insurance policy, but they also have an extra option called a professional corporation. And so we want to see how this comes into play with respect to Dr. Mark. And the question, should he contribute to his RRSP, and if so, how much? We talked about, and I just have put this slide in, we talked about this in the real life story at the outset of tonight's session. We talked about the person who had maxed out their salary so they could max out their RRSP, and that was the accumulation phase of their career when they were putting money into their RRSP. And then you can see on this slide they hit age 71, and then they get into the depletion phase where the money gets moved from one bucket to another bucket called a RIF, and they have to start withdrawing that. So that's the question. So Dr. Mark has an option that as an employee, let me start over again. Dr. Mark has an option that an employee or an unincorporated professional doesn't have. His professional corporation can be used to accumulate retirement savings in a corporate investment account. If he contributes to his RRSP, he will be required under the Income Tax Act to convert his RRSP into a RIF by the end of the calendar year that he turns 71, and start to withdraw from his RIF when he turns 72. The withdrawal will be taxed as ordinary income on his personal tax return, and will continue until he reaches age 90, should he live that long. Now, that's if he contributes to an RRSP. And when he hits age 71, he will have to start to withdraw at least 5% from his plan each year. And you can see on this slide the various percentages that he has to take out of his plan as he increases in age, should he live that long. So if he's facing a decision here, do I put money into my RRSP, or do I leave the money inside of my professional corporation and invest it there? If he decides to leave the money inside of his professional corporation and he reaches age 71, no one is going to say to him, you now have to move that investment into another type of investment and start withdrawing it from your professional corporation when you're 72 and beyond. He doesn't have to do that. He could make his professional corporation a savings vehicle, and no one will tell him at any point in time, you have to start taking money out of your corporation. He maintains complete control over his investments. Whereas if he opts to do what my other client did, which is to put money into their RRSP, then each year after this person has turned 71 years old, he will have to take out at least 5.28%, and you can see it increases. So that's why I said when this person hit age 72 with $6 million in their RRSPs, they have to take out 5.28% of that. This year alone, $310,000. That's 5.28% times $6 million has to come out and be reported on their tax return, and they pay tax on that. If Dr. Mark leaves his money inside of his professional corporation, there's no requirement to take money out and start paying tax on it. All right, we talked about this slide a little bit earlier. You can see that once again, if he goes the route of putting the money inside of his RRSP, then you can see the rates of tax that he's going to pay as he's forced to withdraw it under or out of his RRIF. All right, so the summary, depending on the level of the RRIF, will have an impact in terms of the following. In Dr. Mark's case, he risks having his old age security when he retires clawed back because his income could be too high. In the case that we started out with earlier of the doctor who has $6 million in his RRSPs, his old age security will automatically be clawed back for the rest of his life. That's about $8,000 a year as a benefit, gone. His income, because it exceeds $79,845, because $310,000 of RRIF income is more than 79, it's fully clawed back. The withdrawals are taxed, as I've said, as ordinary income, so taxed in the highest possible form of income. And there is no requirement imposed on him if he were to leave the same money inside of his corporation. He has more financial flexibility by virtue of his option of using a professional corporation than somebody like an employee or somebody who's an unincorporated medical professional. And so when someone finds themselves in that situation, then they have to consider whether or not it makes sense to incorporate. Now, not every healthcare professional, not every physician has the option of incorporating. Some work for hospitals and they earn $350,000 or $400,000 a year and they get a T4 slip for it. They can't run that money through a professional corporation. Their employer, the hospital, won't permit that. They've been hired as an employee. When somebody finds themselves in that situation, and that's not the case with Dr. Mark here, he earns fee for service. But if somebody is an employee, they have no choice, then the RRSP becomes a very, very important part of their retirement planning because they can't leave money inside of their corporation. So that's why I come back to the point that I made at the outset, which is to say, I'm not trying to convince you one way or another here as to whether or not an RRSP or a professional corporation is better. It depends on the circumstances. So if you find yourself working for a hospital earning income over and above $220,000 a year, and it's more than, and what you're earning is more than you need, an RRSP is definitely something you're going to want to look at. And even if you are practicing through a professional corporation and you have a spouse who has low levels of income or isn't considering or isn't contributing to an RRSP, that's a spousal RRSP, as we'll talk about in a few minutes, is also a good option for them. Again, this comes down to what your circumstances are. This isn't a hard and fast rule. I'm just trying to give you some of the pros and cons based on the scenarios. Now, if we look at this particular scenario of Dr. Mark, remember I said he's making $735,000 a year. He's drawing a salary of $235,000 out. So his income inside of the corporation is, we're looking at $500,000 of income now. So his corporation is reduced because he's drawing a salary. So that's a good thing. Bringing that corporate income down will enable him to use the small business deduction and keep the corporate tax at 11.5% if he's in Ontario. But then let's look at the tax at the personal level. You see he's earning $235,000. That's the salary he's drawing out of his corporation, partly because he needs it for his living expenses. But you can see the level of income at the top rate here is 220,000, which is what I was talking about. So he has $15,000 of income that is taxed at the top rate. So what is a good strategy here? Well, I would say for Dr. Mark in this case, you know what? Contribute $15,000 to your RRSP, because that $15,000 contribution can then be deducted against your income and bring your income down to 220,000, get you out of the top tax bracket. Okay, so that's something to consider in terms of the use for this particular individual situation. He's taking out more than the threshold of top income. So using an RRSP to get himself out of that is not a bad idea. Now, I want to draw your attention to something else, because I don't want you going away from this session saying, Jonathan Tucker says that I should leave all my money inside of my corporation. And somebody says, yeah, but did you think about how much tax you're going to pay on that passive income? Remember, I said here that the corporation is earning $65,000 a year. If he wasn't incorporated and if he was contributing income, or if he was contributing a portion of his income to his RRSP and say the amount of income that was being generated inside of his RRSP because he built up a good amount, then that income inside of an RRSP would not be attracting tax. And so whereas the money that's sitting inside of his professional corporation right now as passive income may be attracting tax. We need to think about that, because if the income that he's earning on the money that he's left inside of his corporation, in this case, $65,000, is being earned in dividends or interest, that type of income, that income is going to be taxed at 50.17% inside of his corporation. Hey, hold on a second, Jonathan, what do you mean? Like, why are we even talking about that? If there's a 50% tax rate on investment income, surely the best solution here then is contribute to my RRSP to let that $65,000 grow without being cut in half by tax. On the right side of this slide, I make mention of an article written by Jamie Gollenbeck. He's a CPA CA. He's written an excellent article on this, RRSPs, a smart choice for business owners. I commend it to you. Go online and get it and read it if you'd like to study some more on this. He makes a very valid point. If Dr. Mark, in this case, leaves this $65,000 inside of his corporation and he invests it in the type of investments that either generate dividend income or generate interest income, half of that income is going to go in tax. Yes, it could be refundable and he can get some of it back, but until he takes the money out of the corporation as a dividend, he won't get that back. That $65,000 will be subject to tax at 50%, 50.17%. So what the heck do you do to get around that? What you look for then, as far as your investment policy or your investment strategy on assets held inside of your corporation, is to buy the types of investments that will grow in value. You're looking at ETFs, stocks, even real estate or things like that, that are going to grow in value over time, but not pay off, spin off income like dividend or interest income. You buy Tesla stock and you sit on it for 20 years. It doesn't pay out any dividends. It just goes from $1 to $1 million. And as long as you own it and it's going up in value, there is no tax. You pay the tax at the end. And if you're strategic enough to invest your money in that form or other, you'll find that Jamie Gollenbeck agrees that at the end of the day, when somebody earns capital gains inside of a professional corporation, instead of pulling that money out and putting it into their RRSP, they are actually better off doing it. But if you're going to leave your investments inside of a corporation and invest in things that generate dividend income or interest income, then the conclusion Gollenbeck reaches is no, you might as well take it out and put it inside of an RRSP and pay the tax at the end of the day, at the end of your career, when you're pulling it out, then you'll be better off, and I agree. So I just want you coming away from this understanding that, yeah, it's not as simple as just to leave your money inside and just invest it in mutual funds that generate dividend income and interest. No, you've got to be specific in order to ensure that at the end of the day, you have a good outcome. So this is the article. Take a look at it. it's well worth the read. Now, I want to then move to our third and last case study. This is somebody who's at the end of their career. Dr. Vijay is 60 years old. He's married to Zanita. She's 53 years old. He's earning $250,000 a year through his medicine professional corporation. The goal, retirement planning and minimize tax. You'll notice the RRSP balance here. Vijay has 2.4 million. Zanita has 250,000. The available RRSP contribution room is at the bottom of the slide, but they have a decent amount of RRSP contribution room. All right, let's move to the next page. He has investments inside of his MPC of $2.3 million and retirement age is 65. What should have been done differently for Dr. Vijay and his spouse Zanita as we look back at this fact pattern? This actually came out of a client that became a client of the firm a few years ago. And when I asked the person about what they had in their RRSPs, he proudly said to me, I have a little over $2 million in mine. And I said, and what about your spouse? And he said, oh, she doesn't have anything in her RRSP. You'll see in a second that that's a problem. And that's a problem that can be remedied by using a spousal RRSP. So we've talked about the RIF table. All right, we're going to move on to what could have been done differently. What could have been done differently for Dr. Vijay in this case is to use a spousal RRSP. What am I talking about here? Let's take a look. All right, in this case, you remember Dr. Vijay had 2.4 million, Zanita had 250,000 in hers. He has an unused contribution room, which he can continue to put money into his plan. I said to you about the client who came a couple of years ago who had 2.4 million in his plan and nothing in his spouse's plan, or in this case, 2.3 million in or 2.4 million in RRSP versus 250. What's the problem here? Well, the problem is, as you can see from this table, he is going to have to withdraw money out of his RRSP at $2.4 million, and he's going to have to pay tax, or he's going to have to withdraw these amounts, which is going to be a large amount of money on his personal tax return and a little amount of money on his spouse's return. And therefore, what you're going to see is that there is a tax cost to what he's done. What can he do in the future, which is the second question on the slide here? What can be done for the remainder of his career? What he can do for the remainder of his career is put money into continue to make RRSP contributions, but make spousal contributions. So let's look at the scenario here. Option one is the current scenario. He's got $2.4 million in his RRSP. The RIF table says he has to take out 5.4% of that. That's $129,600 that he'll have to report in income starting at age 72. She has 250,000, so she takes up 5.4%, and that's $13,500. The income tax for him on the 129,000 is $37,304. For her, $41. So in total, between the two, they're paying $37,345 in tax. He, because his income is over the threshold, he has a clawback of his old age security, which is effectively a tax. So at the end of the day, that $2.4 million, which turned into $129,000, is costing him $44,707 in tax. If he had done things differently and was able to split his contributions so that there was more balance between the two, you can see in the scenario at the bottom of the page, option two is to use a spousal RRSP. Then he would have 1.325 million in his, she would have $1,075,000 in hers. And then this was the missing piece, by the way. He had unused contribution room of $250,000. So we could bring the two plans into an equal balance. Look at what happens then. Now he has $71,000 of income, 5.4% of that, compared to $129,000 up here. She has $71,000 of income here compared to $13,000 here. Down here on $71,000, he pays tax at $14,781. Up here, it was $37,000 plus the OAS clawback. Down here, she pays tax at $14,781, whereas it was $41 here. At the end of the day, the total tax burden for the two of them is $29,000 by evening out these two plans. $29,562 compared to $44,707, a pure tax savings of $15,000 each year. That is a very compelling case for using spousal RRSP. So what's a spousal RRSP? Well, a spousal RRSP is something that it's a vehicle. It is an RRSP, but it's one in which the contributor is different than the annuitant. In this case, Vijay contributes to Zanita's RRSP, to her spousal RRSP. Vijay gets the deduction, Zanita gets the contribution and the income in the future. So we're talking about income splitting here. One other feature to take into consideration here, if you recall, a few slides back, we had this RRSP withdrawal table. Remember, I mentioned there was a difference in ages. Now Vijay's 72 and he has to start taking out money out of his RRSP, but his wife is 7 years younger than him. And so because of that, he can reduce the amount he has to take out because of her age. He can use her age to his advantage and thereby reduce the amount of money that has to be reported in income out of his RRSP each year because of the use of her age rather than his. At 65, she only has to take out 4%, whereas for him, it's 5.4% at age 72. So a compelling case for utilizing a spousal RRSP. Again, you want to look at each scenario to consider what makes most sense. Sometimes spouses who don't have RRSPs are members of a pension plan, and so they've already got pensions accruing and things like that. So that has to be considered. But the point here is just to say there is another option besides just taking all of that money into your own RRSP. You can use a spousal plan. All right, I think we've covered off what I wanted to cover off. Now, after that, do you have any questions? Mustafa?
Yeah, we have a couple here.
Okay.
The first one is, how much do you suggest that somebody contribute to their RRSP?
You mean overall? I take it that is what the person, rather than do I contribute $20,000 this year? I think that is that the, okay.
They're asking if there's an optimal amount.
Okay, let's work backwards. Remember the scenario where we started today's session and the person had $6 million in RRSPs and they have to take out a little over 5% of that each year. And so that's like $310,000, which is way too much. So what I suggest to clients is that they pick a target number. Normally, if we were dealing with a scenario where somebody was making $80,000 or $90,000 a year and had a day job, we wouldn't be considering this question because they would never contribute too much to their RRSPs potentially. But for you as healthcare professionals who earn a lot of money, you need to be considering, all right, is there a target amount that I should be building my RRSP to? Notice I didn't say contributing, but building it, because it's one thing to put money in, but also remember that money inside the RRSP is going to continue to grow. The income is going to grow and the value of the account is going to increase as a result. So you may only have to contribute $700,000 of actual contributions for it to accumulate to $1 million by the time you retire, let's say. If that's the case, and you've got $1 million inside of your RRSP by the time you're required to start to pull it out, there's $1 million and you're age 72. How much at a minimum are you going to be required to report an income at age 72? It's going to be $52,800, 5.28% of $1 million. So what I suggest to people is this. think about every $1 million you contribute to your RRSP as representing at least $50,000 of income every year once you reach age 72. Now, is that too much on your tax return or is it too little? To my mind, I know I will have 50,000 on my of RRSP income coming out or RIF income coming onto my tax return every year. I will have maximized my CPP, so I'll start to earn CPP, and that's going to be about $20,000 roughly. So 50 plus 20, I'm up to $70,000. Maybe I have some investment income. I have my old age security of $8,000. I'm up to $80,000. To me, that would be perfect tax planning. Why? I get to keep my old age security. It's not clawed back because I'm not above $80,000. Remember, at that point, you'll have low living expenses unless you have high medical expenses. But typically at that stage, you know, you should be, typically you'll be able to live on that kind of income. If you've got a spouse, then the two of you earning $80,000 is $160,000 coming into the household. That's probably not a bad amount of income, and you're paying minimal tax on that. And at the same time, you're not having your old age security clawed back. So if I was to say to people, think about the target amount you want to have in your RRSP is, say, $1 million per person, because that's going to translate into, you know, at least $50,000 of taxable income as you're forced to start to draw it out. I use that as just kind of a rough benchmark so that you can start to think, okay, if I build my plan to this, down the road, it's going to require that I report this amount of income on my tax return. Hopefully that answers your question. Anything else?
Is it better to invest in RRSP, TFSA, or in the MPC?
Well, I guess the twist on that one is the TFSA versus the RRSP. I mean, I think we've talked about contributing to a RRSP versus leaving the money inside the corporation. If your investments inside the corporation don't generate income each year, but just accumulate or appreciate in value, then there's no tax there. And down the road, assuming that the tax rates don't change, and in the future, you have the choice of how to draw the money out of your corporation. Remember, I don't think I made this point very clearly, but where's the slide? Right here. You remember I said that if you've got money inside of your RRSP, it's going to come out in this column as ordinary income, and remember to be subject to tax here. If somebody's using a professional corporation, they can decide how they want to pull the money out, or if they pull it out at all. If they have a RIF, they have no choice. If they have the money inside of their corporation, they can decide how much do I need to pull out. So, but if they pull it out of their RIF because they have to, then it's going to be taxed as ordinary income. If somebody has a professional corporation, they may be able to take it out as a dividend out of their corporation. Look at the tax rate. They may be able to take it out as an other than eligible dividend. Look at the tax rate. If they're lucky, they might be able to pull it out of their corporation as a capital gain. Sorry about this. But you get to see you have options which you wouldn't otherwise have if you just rely on your retirement income from your RIF. I hope that answered that. So that's part of the question. Now the question then moves to, should I use my RRSP or should I use my TFSA? So what's the difference between a TFSA and an RRSP? The primary difference is that when you put money into your RRSP, you can deduct it against your income. It reduces your income. There's a tax savings component. When you put money into a TFSA, there isn't a tax savings component. There's no deduction permitted. And so if you look at the return on investment, by virtue of the fact there's an added benefit of tax relief on the contribution, you'll find over time the better return, if it's between a TFSA and an RRSP, will be from the RRSP. You have the time value of money working for you. You get money back when you get money back in the form of tax refund with a contribution to an RRSP that you won't get in a TFSA. Now, you should be able to afford both. So I definitely use both if the circumstances were correct. If you decide that you've got a professional corporation and you're not going to put money into an RRSP, I would suggest if you have surplus funds outside of your professional corporation to definitely use the TFSA. If somebody's going to ask me the question, should I take money out of my corporation and put it into my TFSA, I would absolutely say no, don't do that. Why? Because you're going to have to pay tax on the money that you take out for your TFSA, only to put it into the TFSA. If you take money out of your corporation for an RRSP contribution, it nets out to zero. It's a shell game. You have the money in your PC, you withdraw it in the form of salary, so the corporation's income goes down, your income goes up, but then you reduce your income by claiming the contribution, you net out at zero. All you've done is you've just moved funds from one shell to another. Now, is it worthwhile doing that? Yes, in some circumstances it is. Maybe you want to have the types of investments as a strategy, as an investment strategy, you want to have some investments that are generating dividends and that are generating interest income just to even out your risk. Then I'd say, okay, that's the plan for the RRSP. Buy the Tesla stocks inside the investment account inside your corporation and sit on those. But if you're getting investment advice that says, no, but you also want to be earning want to have a diversified portfolio, then use the RRSP accounts to invest in the stocks and the mutual funds and the ETFs that generate dividend income and then generate investment income. And that income can be generated inside the RRSP and accumulate over time, and you don't pay tax as you go. So that's why I'm saying you kind of tailor the approach. But your options really in this question are leave the money in my corp or take it out and contribute it to my RRSP. And then the second question is RRSP or TFSA. RRSP will get you a better rate of return over time because of the tax savings on the contribution that you don't get with a TFSA. I hope that answers that question. What else?
How long can you defer claiming your RRSP contributions? I.e., can you contribute a few years and claim it? Can you contribute a few years and claim it a few years down the road to drop to a lower tax bracket?
Indefinite. Yeah, you could contribute it now and claim it 20 years from now.
And if investing mostly in MPC to avoid RIF, is that a risk if the government changes the rules 20 to 30 years down the road? For example, they've already changed the 50K passive income rules.
Yeah. Mustafa, go back to that last question for a second. What was the previous question?
How long can you defer claiming your RRSP contributions?
Yes.
I.e.,
okay.
Can you?
Yeah. There's one other point. I said it is indefinite. You don't have to claim it. You could just simply put the money in and let it grow tax-free and not claim it indefinitely. How do you know? How do you keep track of those contributions? Each year you keep putting money in and it accumulates and you don't claim it. You want to make sure you don't put too much in, because what you've put in and haven't claimed comes into the equation. I only mention that to say you must each year look at your notice of assessment that you get from the government, because it will tell you what your unclaimed RRSP contributions are. So if you're wondering, how am I going to keep track of that? Your notice of assessment, there's a little box that shows you your contribution room and also the amount of your unclaimed contributions. So the government's keeping track of that because they want to make sure they get their pound of flesh from you if you put too much money into your RRSP. And we get a lot of over contributions. We get a lot of notifications. CRA writes a letter to taxpayers, and it sounds so innocent. We think you may have over contributed. And they wait for a few years to tell you that. They don't rush to tell you that. All the while, the interest clock is ticking at 1%, and the penalty is 1% per month on the over contribution. So that mounts up very quickly. So just be careful. I just wanted to say, if you're contributing and not deducting, no trouble. You can do that, and you can. I don't know why you do that, because you're losing the value of the contribution. But there is nothing saying you have to claim it now or next year or 20 years into the future. All right, now on to the next question, which I think had to do with the impact of tax changes. Is that right, Mustafa? Have I got that right?
Yeah.
Okay. So a couple of years ago, the government decided to put an end to income splitting. And so they brought in these passive income rules called TOSI, tax on surplus income. And they put an end to splitting. We used to, as advisors, say, all right, pay a spouse, pay the kids dividend. Somebody earns $500,000 a year. There's a spouse, there's a couple of kids. Everybody gets $125,000 of income. It's cheaper to do it that way, take advantage of everybody's lower tax rate than one person's tax rate. And that's was the subject of the change in tax policy a couple of years ago. Physicians thought it targeted them only, and it didn't. It targeted every business in Canada. So the question is, well, do I want to keep all of my money in my PC? Because what if the government changes the rules? Well, I think the same question could apply not only to PCs, but to RRSPs. I mean, they've increased contribution limits and things like that, but we're looking into the future and we have no way of knowing what government policy is going to be on the taxation of income in the future. Interestingly enough, there was a survey that the Liberal Party sent around a survey this week on the budget. They're soliciting input. And one of the questions on the survey was about taxing the rich. So I think it's an appropriate question to say, am I going to regret leaving my money inside of my professional corporation? Because is there any other rule changes that they're going to bring in down the line? I have no way of answering that. I don't know what that would look like. At this point, there's nothing they're talking about with respect to the passive income rules at this stage. There's some more exotic types of transactions which the Department of Finance has said they'd like to shut down or curb. But whether they're going to make any changes down the road, I or anyone in the tax community has no way of knowing. A change in government could change the direction of that, and so on. So that has to be kept in mind. I don't know. So maybe the approach to take to that is a balanced approach and saying, yeah, I'm going to build $1 million in my RRSP. I'm going to contribute $1 million to my spousal RRSP. So I got $2 million sitting there, and maybe I got $2 million inside of my professional corporation. So I now have some options. If I have $1 million in each of my RRIFs when they convert, I get 100,000 between the two plans going onto my tax return in retirement, and I can decide what I'm going to do with the money sitting in the corporation at that point in time. I should mention one other thing. The TOSI rules that was the person referred to that prevents income splitting, it doesn't actually prevent income splitting from the standpoint that if my wife owns shares in my professional corporation, she can't because I'm a CPA, and in our profession, unless you're a CPA, you can't be a shareholder. But if that were the case, I could pay her a dividend. I could pay her a dividend of $100. I'd pay her anything. The government's not preventing me from doing that. All that they have said is, well, if you do that, John, we'll charge her tax at the highest rate on that $100. So she would pay $53.53 on that $100 dividend. So why would I do that? That would be crazy. So effectively, they've shut it down, although they haven't prohibited it. They just said, we'll tax you at the top rate. When somebody hits age 65, those rules on TOSI rules that prohibit income splitting, they don't prohibit, but effectively prohibit it. Those rules are set aside and income splitting can resume. It's another way of getting at that money inside the professional corporation. So that's something to keep in mind. Once you've hit age 65, then the TOSI rules in most cases don't apply. All right, what else? Any other questions?
Yeah. In terms of investing inside the MPC, so if we're buying, for example, ETFs, we should avoid dividend-paying ETFs.
If you're trying to minimize the tax, in other words, if you don't want to pay tax at 50.17% on the income that's generated from those types of investments that generate dividends, then yes, that would be the strategy. Now, let me tell you this. Whose advice do you follow here? Do you follow the advice of an accountant, or do you follow the advice of an investment advisor? If the investment advisor is saying, we think this is a good investment, far be it from me to question the investment advice that's given. You should follow a good investment advisor's advice, but just understand the tax consequences of that. So I'm not telling you to give priority to tax at the expense of good quality investments. I'm just making you aware of, if you leave the money and that income is taxed inside of the corporation, that will be the consequence. You will pay tax at that amount, and the only way you'll get some of that tax back is to take it out as a dividend. Whereas if you say, all right, I want to set up a structure so I can access both, then you're going to use both the PC and both the RRSP. The RRSP is going to generate the dividend and interest income, whereas the investments inside of the PC are going to be the ones that don't generate dividend and interest income. They just appreciate in value. That can come from ETFs, mutual funds, buying real estate, buying gold, things like that that go up in value but don't actually generate income that gets reported on a tax return each year. It just appreciates in value over time. Anything else?
If you're still paying off your line of credit, does it make sense to contribute to your RRSP versus pay down the debt?
So there's two sides to this. One is peace of mind. Do I feel more comfortable? Having no debt, or can I live with the debt because I know that I'm paying interest at a very low rate right now, and the chances are that I can earn a higher rate of return than what I would pay on my line of credit. Right now, my line of credit is prime minus 0.25. That's typically the rate the bank charges. What can I get if I invest the money? If you can live with having debt and you can get a higher rate of return, then maybe you're going to want to invest. But having said that, we are living in incredibly difficult times right now in terms of market valuation and market risk. So bear that in mind, because if you take that strategy and you invest and you lose money, not only have you lost money, but you still have the debt. And you still have the non-deductible charge. If you put that money inside of an RRSP, then the interest can't be deducted. If you invest outside of the RRSP, then you can claim the interest, but you don't get the deduction for the overall contribution.
What happens to RRSP when you die?
Great question. So let's go back to the story I started with. The person has $6 million in their RRSP. They live a couple of years. Each year they've taken out the minimum amount and reported income of $310,000. And then sadly, they pass away suddenly. There's now, let's say, $5.5 million inside of their RIF. Or maybe it's a different scenario. The person's 55 years old and they've got $3 million or whatever. On death, the RRSP, two scenarios. One is the person is in a common law relationship or has a spouse. In that case, the RRSP can roll over to the person, the surviving spouse, tax-free. So it rolls over. That's scenario number one. That's what happened to the person that the real life story we opened with. His partner passed away a couple of years ago, and her RRSP rolled to him. So no tax at that time. When this person passes away, when the surviving spouse passes away, it all comes into income. So if this person has $5.5 million left when they die, their estate will have $5.5 million of income on which they'll pay tax at 53.53%. End of story. That's for an RRSP or a RIF.
If you max out RRSP at a young age and contribute yearly to compound interest, can you retire early and withdraw RRSP before 65 or turn it into a RIF? And is there any downsides to doing this?
Say that, I'm not sure I understand that question. Try that again.
If you max out your RRSP at a young age and contribute yearly to compound interest, can you retire early and withdraw RRSP before 65 or turn it into a RIF? And is there any downsides in doing this?
I'm not sure I understand the question, so let me try to decipher this, which is this, I think, is the question, can I start to take money out of my RRSP or out of my RIF before I reach age 72, before it becomes a RIF? You can take out money out of your RRSP at any time you want. That's a decision. You know, one of the strategies that we did with this person that I've been telling you about throughout is we said before he turned 71, we had to take out some money out of his RRSP to try to reduce the amount of the overall amount that was in his, that would go into his RIF. So you can take money out of your RRSP at any point in time. I'm not sure about the compound interest piece. I mean, interest rates are negligible right now, so I can't imagine you'd be earning a lot, but whatever you earn on interest is going to be taxed as ordinary income, like we talked about. So I'm kind of struggling with the question.
Yeah, I'll just give them a chance to rephrase maybe if they'd like, but I'll move on to the next one.
Okay.
Should we buy a house first or maximize RRSP/TFSA first?
Okay, great question. Thanks for asking that. What do you need when you buy a house? You need money. If you put money into an RRSP, what happens? You don't have access to it, except if you use the home buyer plan. How much is the home buyer plan? It is $35,000 per person, assuming the person has not owned a principal residence in at least the previous, effectively the previous 5 years. So if you've never owned a home before and your plan is to buy a home, the strategy is, provided you have the contribution room, contribute $35,000 to your RRSP and stop contributing after that. Put $35,000 in. If there's 2 of you, each of you put $35,000 in, so you now have access to $70,000, $35 each. I wouldn't put more money into the RRSP at that point. Why? Because I'm going to need money. I'm buying a house. I'm going to need it for a down payment. I've got to buy window coverings. I'm going to have a mortgage to pay. So I wouldn't be doing that. I wouldn't be putting more money into the RRSP because I know I'm going to need cash. And by putting money into the RRSP, I'm losing access to much needed cash. Now, before you make the decision to buy the house, remember what I said at the beginning, which is how much money do I need for retirement? That's the more important question than the house itself, because at the end of the day, you're going to need a stream of income in your retirement. So you better get that part started. So figure out how much a month you're going to need to set aside so that you hit that amount when you choose to retire. If it's 50, 55, 65, 70, whatever, save to that target. And I would say in that case, if the RRSP becomes a part of the plan, then yes, that would be the exception to what I just said, which is just put 35,000 in. Because if you're saying, okay, yeah, well, I need, like I showed you in that slide earlier, I need to put $1,200 a month in. Fine, put $1,200 a month into each of your RRSPs if that's the case, and consider that, or leave it sit inside your corporation. But the point I'm trying to get you to look at there is make sure you've considered the long-term savings target so that you know that, yeah, each of us need 1.3 million or 1.8 million or 2 million or whatever that number is, so that you don't lose sight of that goal. The problem I find with people is that they don't know how to go about figuring out what the end goal is. It's not hard, but you've got to figure that out and then save towards it. And then the house piece comes in. But I wouldn't put more than 35 in, and I wouldn't put more than the savings amount needed to hit my retirement target. That's how I would look at that.
So once the MPC has paid tax on the dividends in its investments, the shareholder will not be taxed on the dividends they withdraw. And how do they keep track of that?
Okay, now you're getting into the taxation of investment income, and I'm going to deal with that question in an upcoming webinar. And the reason I'm telling you that is I'm not trying to separate, I'm not trying to move away, but I need to show you that on on a schedule so that you can see the tax at the corporate level and the tax at the personal level. But I will give you a teaser. Remember we said that if you earn investment income inside of the corporation, it's taxed at 50.17%. The money's sitting there, you've earned it, the corporation's paid its tax at 50.17%. Now, that tax that it's paid is called refundable dividend tax on hand, RDTOH. There's different types. There's eligible refundable dividend tax on hand and non-eligible dividend refundable tax on hand. But the point of that is, as you pull the money out of the corporation, you are going to have to report the money you pull out as some type of dividend. Wait, what do you mean? I'm going to have to pay tax on that as well? Haven't I already paid 50.17% at the corporate level? Yep, you absolutely have. And now you have to report the same amount of money that you've pulled out, or the amount of money you've pulled out, and you've got to report that on your personal tax return. Wait, that's double tax. Well, it is if it weren't for the dividend tax credit. And that's what we'll talk about in the taxation of investment income. The intent that the government has, it's called integration. That's the concept of integration. And the concept, it's a notional amount, but the concept is that the government will give the taxpayer credit at the personal level for the tax that's been paid at the corporate level. So that if in principle, you're not being taxed twice. I'll leave it at that.
That's all for the questions.
All right, thank you, everyone. I hope this has been helpful. Thanks for your participation. If you have any further questions, feel free to email me and or give me a call. You can see my contact information is on the slide. If you have, if you're a medical resident or you have friends or colleagues that are currently residents or fellows, we do offer assistance in terms of providing tax preparation services. So feel free to pass that along if you think it appropriate to those that find themselves as either residents or fellows. But we will leave the presentation at this point and conclude for the evening. And thank you once again for your time. I hope it's been helpful. Have a good evening.